G'day everyone, welcome to the weekend general update for the 6th and 7th of April. And in the week after Easter, an absolutely fascinating week around the world. We've got a lot of instability centered around North Korea at the moment. We've got a few negatives in America, but we also have some massive positives coming out of the Bank of Japan announcement. Now, the net result was that markets in the US didn't ended up going a long way, but we're starting to see a little bit more volatility. So there's certainly some fascinating tug of wars going on at the moment. So let's get on and have a look at a summary of what actually happened last week. The S&P ended up declining 16 points on the week, dipped sharply on Wednesday and initially again on Friday on some weaker jobs numbers. But there was a pretty good recovery. And I guess the thinking is the known amount of stimulus, which is what's already in the pipeline, plus the massive stimulus program that the Bank of Japan came out with during the week, but also the weaker job numbers. I think people, when they had a second think about it, realised that this would probably almost remove any possibility that the Fed's going to stop printing money at $85 billion a month. And so as a result, the stock market recovered again. And my thinking still is that the correction that we're going to have over, or that we're in at the moment, is going to be pretty mild, and it's perhaps going to be more of a sideways move than anything else. Now, the ASX 200 index was pretty awful last week, down 75 points, and we're back into significantly underperforming other markets around the world. And I talked about this about a month ago in terms of the fact that the Australian dollar and bond yields, and also relative to stock yields, particularly our banks, are less attractive now than perhaps they were a few months ago, because prices had continued to rise. And so overseas money, which is a big driver of our market, was starting to perhaps turn around and go back the other way. And certainly what's transpired over the last month certainly would support that process. So we've been far weaker than the US indices over the last week or two, and resource stocks had an absolute shocker last week, and we'll have a look at that on a relative comparison chart. Small caps also came in for some pretty active selling as well, so there is quite a few negatives around. However, the non-resource stocks, the good ones in Australia, still going along great guns. Some of them in fact rose on the week, and any that didn't rise on the week were not much worse than flat. So it's only really the banks that have been holding the index together. Otherwise, we would have been down more like 120 to 150 points last week if the banks had been sold off to the same degree as the resource stocks were. Now, US bond yields, and this is a really interesting situation at the moment. The 10-year yield dropped very sharply and unexpectedly in the US, and that's not really what we would have expected with the market holding up where it was. The yield suddenly dropping like that means that bond prices have gone up, which means money is going back into the bond market. And normally you'd expect to see the equities market weaken significantly, but that didn't happen. You'd also expect to see the US dollar higher, but that didn't happen either. So there's some really weird stuff happening in America, and I guess it's the normal relationships between different asset classes just aren't holding at the moment. And I think it's largely because of the massive amount of central bank intervention and stimulus is really breaking apart those historical correlations that we've been used to seeing. So, as I said, it's inconsistent with the continued strength in equities and also where the US dollar went. Now, Eurobond yields is something that I've been watching very, very closely now for several years, and with the situation in Cyprus, there was a lot of concern that this could spread to other areas in Europe, but both Spanish and Italian 10-year yields have been holding steady for months and haven't really moved at all. So I think that fear of contagion again in Europe is more of a media situation than necessarily how the major players are seeing it. And the US dollar ended up falling marginally on the week. So let's have a look at a few charts, and we'll start first of all with the S&P 500. We're looking at a view here which starts back around about March of 2012, so we're looking at about 12 months of data. Now, we did have a significant low in June in the US market, and since then it's been all upwards direction. And we've basically got up to, if we pan back, you can see we're up here now at the all-time highs. So we're above the highs of 2000, and we're at the same level as the highs of October 2007. Now, at such a vital level, you would expect to see some pause or pullback, and that's what we're getting. And you'll notice here that I've marked a little green box zone, and for various reasons, various Fibonacci retracement levels and other support levels, this is the zone from maximum to minimum that I believe the correction could play out in. I expect that it's going to be closer to the top of this range than the bottom. But anywhere in that range between around 1480 and 1530 is the area that I would expect to see this correction in the US market bottom out at. Now you can see that we had a sharpish move on Wednesday, and then initially the market was down sharply also on Friday night, but recovered quite nicely. So still looking pretty good, and as I said, I really think we'll see some sideways action for a period, and that might be about the worst of it. Just while I'm here, I'll just have a look at the Shanghai index because that's interesting. Shanghai index, whilst other global markets had been going up over the last year or so, Shanghai index plunged quite significantly, but equally has recovered very nicely, and we're now just getting a bit of a retracement back in the Shanghai index, but it's still looking in reasonably good shape at this stage. Now just some of the internals of the US market. This is the Nasdaq, and you can see that it's hardly off its highs. So the technology area of the market still being very well supported, and the Nasdaq is often a leading indicator of what's going on in the American market, and there's no signs of the technology index turning over at this stage. Now let's have a look at the other leading indicator of the American market, and that's the Russell 2000, the small and mid-cap stock area. And you can see equally there's not a lot of weakness there in the small caps either. It's not far off its highs. So things looking pretty good within the US market. If we turn to our index, this is the XJO or the ASX 200, and by comparison you can see considerably weaker, and it's been really a rough 2 or 3 weeks, and that's been very heavily because of the resource sector, and there is resources very, very ugly. Let's just have a look at a relative comparison of the various sectors in the Australian market. And we look at this relative comparison chart each week, and starting at a year ago, starting with the common point about 5 years ago. But if we just look at the last year, you can see there's been an enormous divergence. Up the top we've got healthcare still way out in front in terms of being the best performing sector on our market. In the blue we've got finance, and just under that in the green we've got telecommunications. You can see how those uptrends now have really gone off the boil in the last month, and they've really been tracking more sideways than anything else. Energy was going along okay, but has turned down in the last 2 weeks. And then you can see at the bottom we've got the Small Ordinaries Index in blue, and then very much at the bottom of the pile is the Materials Index, which is obviously BHP and Rio. And you can see just how big a gap has opened up between materials and, let's say, finance, health, telecommunications. So massive divergence there in the Australian market. And at some point these resource stocks and I believe fundamentally they're there now. I mean, BHP and Rio are probably at quite attractive levels, but I'm not sure that they've hit the bottom as yet. So let's have a look then at gold, because there really was quite a significant reversal on Friday night. So gold ended up losing $20 on the week and tested 1550 support level yet again, but really bounced in a major way on Friday night. So we'll have a look at that in a minute. Copper, it continues to be a bit easy, down to 336 a pound. Oil also fell about $4 on the week, down to 93. This is the 6-month spot copper chart, so you can see since the highs in February, it really has fallen quite a way quite quickly, which is a sign that's inconsistent with a lot of the other indicators around the world. So let's take a look at the chart of gold. So this is gold on a daily basis. In fact, let's just look weekly first, get a bigger picture perspective. So this is the weekly chart of gold. We had a massive run up from $700 an ounce, 34 months to the upside. We're now something like 19 or 20 months into the consolidation. 1550 has been an absolutely critical level. It's been tested both ways many times. Tested again last week. As you can see, we had a dip under 1550, but it certainly didn't close there. Let's have a look at the daily chart now, and you can see sold off quite heavily on Tuesday, Wednesday and Thursday of last week, turned around on Thursday and really confirmed the reversal on Friday night. So there's quite a strong probability that we're going to see a move back up in gold now. And frankly, the conditions or the sentiment for gold around the world are just so poor that this really would be a perfect point for this to be a major low point in gold. Let's have a look at the indices, the stock indices, and see what they did. This is the GDX, which is the major stocks. You can see that we've had a reversal on Thursday off support. Initially traded higher on Friday, but did close pretty much back where it started on Friday. But the junior index, the GDXJ, actually did better. So we got the same really nice reversal on Thursday, and it actually outperformed a bit on the Friday. So certainly some slightly more encouraging signs for gold and gold stocks. So we'll see how that plays out over the next week or two. So that's it for this week. Talk to you next weekend. Cheers.